Good day, everyone, and thank you for joining the Market Chameleon webinar series. Before we get started, let's take a look at the share disclaimer. Be aware that neither Market Chameleon, Dimitri, or myself are registered investment advisors or a broker-dealer. If you're searching for investment advice, please reach out to a licensed professional. These shows and webinars, like all our shows and webinars, are for informational purposes only concerning Market Chameleon tools and products. With that, one last look at the disclaimer, and let's welcome Dimitri Pargamonik to the stage. How you doing, Dima?
Good morning, Will. How are you?
Good. Today we're going to look at using theoretical value benchmarks.
Yep. Let me share my screen. And we're going to do this from the option chain. So before we get started, let me navigate to an option chain and then we'll discuss it. Let's use Google here for an example. So I'm going to type in Google. We're going to come to Google's main summary page. And on the left-hand side, we have a menu. We're going to click on options, option chain. I'm going to click on this menu to minimize and expand our screen. And what we're going to do here is when we look at an option chain, we have all these different option contracts with prices, right? So these are different option contracts available for trading. On the left-hand side, we have the different expirations. For example, here, August 22nd. If I click on it, this brings up the August 22nd option chain. On the left-hand side, we have calls. On the right-hand side, puts. These are the different strikes in the middle. So you could see here, if I find a particular option, in Google in August 22nd, I could go to the 200 call. I see the bid and the offer. So this is the best price, or the highest price people are bidding for. The displayed bids, these are the lowest that people are willing to sell that option at 365 at that moment. So when we look at all these options, right? So we have all these different options because we have different strikes, we have calls, we have puts. Some are further out of the money, some are at the money, some go to the upside. And how do we quickly try to assess are the current premiums elevated? Are they subdued? Are they in line with some kind of a benchmark? So when we compare, prices, we do it on a relative basis. What's our benchmark, and then what do we think the value of these options should be based on certain assumptions, and then what is the actual market price? So, like, for example, if you're trying to invest in a rental property and it's for sale, well, the market price, or the selling ask price by the seller, whatever, he's $200,000, he wants to sell a rental property. Well, how do you know if that's high or low or reasonable? Well, you have to create some kind of benchmark, right, to try to assess how far away are we. So you could do that by comparing, run a model and say, well, what are the most recent sales prices for similar rental properties? Or, create a model where you do cap rate where, based on this amount of net rental income and required 8% return, this is what I think, it should be worth in theory. And are we close to it? So if you generate $100,000, 200,000 could be high. How do I justify that extra 100,000? Maybe you generate 300,000. That seems low, and you have to still do your valuation while, what's, maybe there are issues with it and so forth. So how do we then do that across the board on an option chain? Because we have all these different prices here, so we could go one by one individually, and try to run a theoretical value on this particular option using an option pricing model, given an implied volatility input, and all these other, and then figure it out. Um, and another starting point could be where we just generate a theoretical value. So these values in the middle are theoretical values. So we could compare the market prices, across the board using some like standard model. And to do that, we could use this feature here, theoretical values. So this is defaulted to this best fit line, which kind of just runs through the implied volatilities and creates like a smoothed out curve to see if anything is like jagged in there. But let's say we wanted to run our own model. I'm going to drop this down. And what if we wanted to see how these option prices look like their values if we gave an implied volatility or volatility assumption, right? So we have to come up with a volatility assumption, put it in the option pricing model, and see how these option premiums compare to that. So we have these different quick buttons where you could enter in a custom volatility. You could say, well, if I think, if my opinion is volatility will be 20 in Google, between now and August 22nd expiration, we could choose this, enter in 20, right? And then press OK. And this will rerun everything, all these theoreticals. Now, for each of these options, creates a theoretical value based on 20 volatility. And then we could compare it and say, whoa, if this option, if we assume Google is going to move at a 20 volatility, well, these options are implying a much higher, volatility, and they're priced higher. You can see here, this bid is 28.4. So it's 78 cents bid instead of closer to 18 cents. All right. So we could see what the difference is in the price. Well, if I'm right, and it's a 20 volatility, this option is worth 18 cents. Well, the market is paying 60 cents higher, right? So I'm getting 60 cents edge over my theoretical value, right? What I think it's worth. And we could, there's no right, we don't know what the volatility will be, right? We're just making assumptions and comparing it because the volatility is based on something that's going to happen in the future, right? The stock movement's going forward. So we don't know that, we're creating this assumption. Or we could compare it to just where was the volatility recently. We could, like over here, we could look at the last 20 days. So this will calculate for us the last 20 days of actual stock volatility. And if we assume that the forward volatility is going to look similar to the last 20 days, let's say we're not expecting anything different from now to August 22nd, and we think that the days going forward look similar to the last 20 days, nothing in the last 20 days happened, like earnings or whatever to skew it. So if we make that assumption that it's going to look similar to the last 20 days, we click on this, press OK. And now we see, well, based on the last 20 days, you could see these options imply a higher vol, right? Even here, they implied, a higher. Let me just see here. If I click on, the last 20 days, the volatility moved at 21, right? So you could see here, the last 20 days historical volatility moved at 21.7, but we see here that these option prices are implying a higher volatility. What if we went back further and said, okay, maybe the last 20 days was slow for whatever reason, and we think that it's going to revert to the 1 year mean longer term. So we could drop this down and say, well, what if I assumed 1 year historical vol? Then this is going to recalculate. And even then, right now the implied vols are higher than the historical volatility Google moved at over the last year. All right, so here we could even see that in the last 52-week average, 20. Oh, I'm sorry, here, yeah, 26. So it moved at a 26. So these are certain ways we could use this Black-Scholes model to create us theoretical values across the board. You know, it's not a perfect model. There's no like, you know, this is exactly what it's, but it's a model, the best model we have right now that we could apply kind of across the board to start getting a sense of where the market prices are versus like our model generated theoretical prices. There are a couple other options here. We could enter in an implied volatility based on historical, so here we used volatility based on historical stock movements. Right? That's what we inputted. But what if we wanted to see historical implied volatilities? You know, maybe the implied volatilities just tend to be higher, you know, than the volatility. Maybe they tend to stay a little bit more elevated in case, you know, an unexpected event happens. You know, something happens that will move the stock. So let's put in the median IV. This is the median IV for these option prices. Okay, so this is the, I'm going to click on this, and what this is doing, so you see these are a little bit higher now, 42, 58, 87s. And what this is doing is saying for a similar option historically, if we go into our database with, you know, 14 trading days and this option, you know, 9.8% away. If we looked at if we looked at our data in last year and sorted it from highs to lows and looked at the one in the middle, the implied volatility in the middle, half above, half below. If we took that implied volatility, plugged it into the Black-Scholes model, then we get, you know, a value of 31, 42. So you could see that right now it is, the implied vols are above that historical median. You could kind of see that here. These are the IV percentile, 79, 80, 70. So these are telling us what percent of the historical observations were below the current implied vol, and then which is 79%, which is saying 81% of the time the implied volatility was higher than this 28. So I'm going to stop right there, Will, because what I wanted to quickly show is that if we're looking at option chains, and there's lots of different option chains for different stock symbols and different expirations. And if we just wanted to quickly run benchmarks to get a sense of where are we in the option premiums, option market prices, we could use, you know, certain models to just generate us, you know, market generated theoretical values based on these assumptions, and then get those important insights or the premiums on the higher or lower end of the historical range.
That was a great webinar, D. The Chameleon community is very thankful that you're bringing these to them. We will see everyone tomorrow. Great job, buddy.
Thanks, Will. Stay safe out there, everyone. Hope you have a great trading day. Hope to see you guys tomorrow.
All right, D, thanks. We'll see you tomorrow, buddy. All right, everyone, remember to follow us on all the social platforms, thumbs up. I will definitely dig into the emails and see if yours have been dropped or what's going on with the service provider. Who knows? But I will look into that. Everyone, thank you very much. Remember, if you're on YouTube, thumbs up, greatly appreciated. Everyone have a great, safe trading day. Bye.